If you think low PE means undervalued and high PE means overvalued, this video will change your perspective because the PEG ratio can prove both assumptions wrong. Hi, welcome to PSI, Plan, Save and Invest. In today's session, we will decode the PEG ratio, what it is, how to calculate it, and more importantly, how to use it in real world investing decision making process. So let's quickly jump into what is PEG ratio and understanding and its formula. So PEG is equal to price, that is current market price, divided by earnings per share. Earnings per share. And this is again divided by or adjusted to the growth rate. What is this growth rate? EPS growth rate. Earnings per share growth rate. So now what is this earnings per growth rate? Earnings per growth rate is nothing but expected EPS growth rate. Usually for 1 year forward, 2 years forward, or 3 years forward, or 5 years forward. Now what PEG tells us? It tells us how much are we paying for each unit of company's growth rate. So it tells us how much are we paying for each unit of company's growth. So now next, like how do we interpret the PEG ratio? That's very important. Before we go to the interpretation, let's take few examples. Like example 1. Stock A. Assume PE is equal to 30 and the PEG ratio, growth rate, EPS growth rate, assume the expected EPS growth rate is 30%. So then what we do is we calculate PEG is equal to the PE ratio 30 divided by 30%. Instead of percent, we just do 30. So this gives you the actual value of 1. And we say this is fairly priced. The stock A is fairly priced. Now let's take another example, another stock like what stock A this is, and the stock B. Let's see like how stock B works. Assume that PE is equal to 15. Most think the stock is trading undervalued or available at cheaper rate if the stock P is at 50. But see the let's value it with the growth rate, and the growth rate is 5%. Assume that expected EPS growth rate is 5%. So then PEG is equal to 15 divided by 5, that is equal to 3, which is expensive. We say the stock is trading expensive and generally we avoid it. So whenever the SEBI tells you that stock is trading above 50, you always have to consider the growth rate as well. If the growth rate justifies the valuation, then you can still invest in that stock. That's what PEG ratio is used for. PE alone would mislead you. PEG flips the perspective. That's what we have to understand between the difference between PE ratio and PEG ratios. Now let's see how to interpret the general interpretation, basic general interpretation of PEG ratio. How to interpret PEG. One, PEG less than 1. We say the stock is undervalued and growth justifies the price. That's what we have to understand. Second, PEG is equal to 1, fairly priced. Next, PEG greater than 2, we consider expensive. investor considers it as an expensive or overheated or overbought. So these are the general perceptions and the general interpretation, but this varies again to the industry and sector. If the sector average PEG ratio is 1.5 and if the stock is trading at 1.2, yeah, you might still consider the stock is undervalued. So you always have to use this based on the industry average. That's what I mean to say. Now let's and also one important point what we have to remember is it works best for growth oriented companies. It works best for the growth oriented companies. Also, there is a difference between PEG TTM and PEG forecasted. One should have clear perspective before investing. PEG TTM, the actual growth rate, PE adjusted to the growth rate for the last 12 months, gives you whether the company reached the expectations. PEG forecasted will tell you whether the growth rate will accelerate or decelerate. Suppose PEG TTM is less than 1, we consider, oh, stock is fairly priced. No, but what you have to think is already company has delivered the results and delivered the expected growth rate results for the PE ratio. If and now different now like suppose but PEG forecasted forward or forecasted is greater than 2, then we have to consider the forward earnings are not going to be as per the past growth rate. Forward growth rate is not going to be the past growth rate. So we should consider the stock might not perform the same. So always we have to look for forward because you are investing today based on the forward expectations. So that is what the usefulness of PEG ratio. Now let's take the use case scenarios. Let's see a few use case scenarios how it can be. Scenario 1. High PE but PEG is less than 1. We say this is hidden gem because on the face it appears expensive because PE is high, but PEG is less than 1 because growth rate is higher. Like assume, let's take an example. PE is equal to 40 and EPS growth rate, EGR I'll take it, is equal to 50%. So then PEG is equal to 0.8. So even though the PE is very high, because the growth rate is also higher, the PEG is less than 1, which is considered it is actually reasonable to invest. Now let's take another scenario. Scenario 2. Okay, low PE but PEG is greater than 2. Okay, then we say this as a value trap. We consider this as a value trap. Like assume PE is equal to 12, but expected earnings growth rate, EPS growth rate is just assume 3%. Then PEG is equal to 4, which is very expensive because we are paying more for the low growth rate. That's what we have to consider. There is another scenario, scenario 3, sector comparison, FMCG versus IT. So like you have to take the average of sector or industry instead of like sticking to your values, less than 1, lower value, greater than 1, higher value. Suppose like if you take FMCG, generally the PE or the PE ratio, average PE ratio of FMCG will be around 50. and the growth rate could be like around 10%. If you look PE ratio and growth rates of FMCG stocks like Nestle, HUL, or Britannia, the PEG will be more than 2 3 or it could be 6, very expensive. On the counter side, like if you look at IT stocks where PE will be ranging between 20 to 30 and growth rate will be from somewhere 20 to 30%, so the PEG will be 1.25, which looks reasonable even though it is greater than 1. So you always has to compare it with the sectors industry average. PEG lets you compare across sectors, something plain where PE cannot do it. Now another scenario, exit signals for long-term investors. So generally long-term investors keep this as an exit signal, like exit if forward PE is greater than trailing PE. We explained about this in our previous video. You can watch it by clicking on the above link. And forward PEG is greater than 2. So few might keep it as an exit signal. But this is always not true in case if you are holding the stock for 3 years and 5 years. So that's when valuation, generally if forward PE is greater than trailing PE and if forward PEG is greater than 2, most of investors do keep it as a red flag. Few might consider as an yellow flag based on the earnings quality long-term perspective. Where do we find growth estimates? This is a very good question because analyst estimates, generally you can find the analyst estimates in Trendline, which is a good platform, Bloomberg, Yahoo Finance, TradingView as well. But Trendline is the best one for the analyst estimates. Company guidance, you can in quarterly earning calls or annual reports, you can get the growth rates, estimates of growth rates. Consensus forecasts, market screener.in, money control, you can get this forecast. But the best practice, what is the best practice? Take average of conservative estimates to avoid over optimism. So like don't take 1-2 analysts average estimates, take 10 analysts or 20 analysts average estimates. If you want to be conservative, take the growth rate less than average estimates. If you are aggressive investor, take more than average estimates. So it all depends on your style of investing. Sector wise relevance of PEG. This is very important. For which sector PEG ratio is best fit, that we have to check. So it is best fit for technology companies, IT sector, pharmaceuticals, biotech companies, consumer discretionary. So these companies, it is best fit. It is moderate fit for FMCG because PEG looks high, but stability justifies the premium. So it is moderate fit. Weak fit for banks and financials. Banks and financial PEG is not, doesn't give more meaningful sense. So for banks and financial, better use price to book value. For banks, price to book value is the actual valuation, and return on equity, NIMs. So these NIMs, net interest margins, these are good for banks and financial sectors. Not suitable for cyclical and commodities where earnings fluctuate. PEG becomes less meaningful. So use PEG where growth is steady and predictable. Avoid it when earnings are volatile or book value matters more. So what are the limitations of PEG? Relies on growth forecasts, which can be wrong. Yes, analyst estimates can go wrong because it's forecast. Future, anything can happen. So that's one drawback. So how do you counter that? Take an average estimates of more analysts, so you can arrive most possible scenario. Not useful for loss making or cyclical companies. Yes, it is not useful. Does not factor in debt, free cash flow or management quality. So PEG is one lens, not the only lens. So I would like to conclude this session telling one important point. So did we crack the entire investment code today? I say no. There is no magic formula. What we did was understand the theory of PEG ratio on its use case scenario and its usefulness. Yes, it is highly useful for long-term investors, even for short-term investors, if they have estimates for 6 months. How it adjusts PE for growth, where it works and where it does not work, we checked in this video. I hope you enjoyed our video. If you liked our content, please like, share, subscribe and comment with your feedback. Thank you. Thanks for watching our video.